Now let us start with reading 53, which is the risk associated with investment in bonds. These are the topics we are going to cover. Firstly, we list down all the risk associated with the bonds. Then we look at the relationship among the coupon rate of the bond, the yield required by the market, and the bond's price related to its par value or face value. Then we'll look at the contribution of the features of the bond to its price and how these features and the bond's yield affect the interest rate risk of the bond. Then we look at the relationship among the price of a callable bond, price of the option free bond, and the value of this call option which is embedded in the bond. Then we will explain the interest rate risk of a floating rate security. Usually it is considered to be zero, but there are specific cases where even a floating rate security can have interest rate risk. Then we'll look at the concept of duration, dollar duration, and its relationship with the interest rate risk. Then we'll look at the yield curve and what is the risk associated with the yield curve and why duration is not able to capture the interest rate risk completely. And we will look at the disadvantages of a callable or prepayable security to an investor. Then we'll look at another important risk, which is reinvestment risk, which occurs in the case of prepayable amortizing securities. We will also look at the credit risk and various forms of it. Then the role of credit rating agencies. We will also understand the liquidity risk and why it is important for the investors. Even if they are planning to hold the security to the maturity date and not trading in it, still it could be important. We will also understand the role of exchange rate risk when the investment is made overseas. We will also look at inflation risk and the impact of yield volatility on the value of embedded option and the value of bond in which the option is embedded. And finally, we look at the event risk and the sovereign risk associated with the bonds. Now let us start. These are the various risks which are associated with the bonds. We'll take up one by one. Let us read them first. Interest rate risk associated with the price of the bond. As we know, when the interest rate rises, the price of the bond falls. So this is the risk for an investor. If suddenly the interest rate rises, the price of bond will fall and the investor will lose the value. There could be call and prepayment risk. This occurs when the interest rate falls and the borrower plans to fund its needs from some other sources and pay back the loan which it has already raised. So that is one risk. There could be yield curve risk, where the shifts in interest rates are not parallel. We'll look into much detail later. Fourth is reinvestment risk. We know when the coupon is paid, it has to be reinvested by the investor if the interest rate is lower. If the interest rate is falling, there is a risk that investor will have to bear where he has to reinvest the coupon at lower rate. So that is a risk associated. There is a credit risk where the borrower is not able to repay the coupon or the principal. There is a possibility of default. Then there is a liquidity risk where if the investor want to trade that bond in the secondary market, he might not be able to get the right price immediately, he might have to give up some edge where we know that bid ask spread is high. So in that case, liquidity risk is high. There could be exchange rate risk. Suppose an investor from developed countries is investing in emerging markets and the currency of that emerging market suddenly falls. Because of that, the value of bond might fall in dollar terms. So that is the exchange rate risk. There could be volatility of risk. If the yield is changing very frequently, the volatility is high, the value of options will change accordingly, which will change the bond value eventually. Ninth is inflation or purchasing power risk. We already know this. If the inflation rate is much higher than the return which we are getting on our investment, on our bond, that means we are actually losing the value. So our purchasing power will fall if the interest rate is lower than the inflation. So if inflation suddenly rises, this is the risk associated with the bond. There are certain specific bonds which are inflation linked. There such risk does not exist. For every other bond, the risk will be there. There could be event risk because of which the borrower is not able to repay, and there could be sovereign risk. There are some problems which are specific to a particular economy, a country. Because of them, there could be a risk of principal or coupon repayments. Now let us explore these risks in detail. Let us first look at the relationship between the interest rate and the value of the bond. So on y-axis we have value of the bond, on x-axis we have market yield or the interest rate. If the interest rate rises, the value of the bond falls. This curve is representing the relationship. Let us first take an example of a zero coupon bond. Suppose there is a bond which is priced at $90, par value is $100, time to maturity is say 3 years. Suppose the market yield is say 3.2%. The bond price was this P1. If this value suddenly goes up and becomes 5%, or in other words, earlier investors were expecting 3.2% return on this zero coupon bond. Now because market yield is rising, they are expecting 5% return on the bond. So what does it signify? Since the par value is going to be the same, the current value of bond will change. It will come down to say roughly $83. So earlier we were earning roughly $10 in interest. Now since our interest expectations have become higher, we are expecting the interest rate of say $17. So this example clearly signify that higher market yield means lower price of the bond. So there's an inverse relationship between the bond value and market yield, which is also being captured by this curve. So now let us look at a specific case. At this point, the market yield becomes equal to the coupon being paid on the bond. So at that coupon rate, the price of the bond is going to be equal to, or the value of the bond is going to be equal to the par value. For example, let us take case of a coupon bond. For example, this is annual coupon bond. Coupon rate is say 8%. par value is 100 and market yield is also 8%. So what should be the value of the bond? Suppose the yield to maturity, which is 8%, and say time to maturity is 1 year. So as we clearly see in this case, if the coupon of 8% is going to be given and the par value of 100 is going to be returned after 1 year, what should be the value of this bond? $100, which is equal to the par value, because 8% is our expectation in terms of market yield. That is why where the coupon rate is equal to market yield, the price of the bond or the value of the bond is going to be equal to the par value of the bond. Let us take another case where the coupon rate is much lower than market yield. Suppose in this case itself, the yield becomes 10%. So this is the bond which is paying you only 8% coupon, where the market expectation are 10%. So what should be the impact on the price? The price should be lower. Since the coupon rate is less than the market yield, the price will be less than par value. That is what is written here. Coupon rate is less than the market yield, the bond will trade at a discount. So in our example, where the coupon rate was only 8%, market yield was 10%, the bond will trade at discount. So it will be less than $100. So it should be $95. If we take the opposite case, where our coupon rate was 8% and market yield falls to say 6%. In that case, the market is expecting 6% return and the bond is giving 8% return. So the bond will trade at premium. The value of the bond will be more than the par value. So it will be say 105, which is more than 100. And if both of them are same, 8%, 8%, the bond will trade at the par value, which is $100 in this case. So this is example and this graph, they are capturing the relationship between the bond value and the market yield. In other words, we are capturing the interest rate risk in this case. Since the market yield is nothing but the interest rate. If the interest rate is falling or rising, how is it impacting the value of the bond? That is nothing but the interest rate risk. Now let us look at the other features of the bond which can affect our interest rate risk of the bond. So the interest rate risk is the sensitivity of the bond's value with respect to changes in market interest rate. If the market interest rates or yield are rising or falling, how is the value of the bond responding to it? That is our interest rate risk. So let us see how the features of the bond are affecting our interest rate risk. The first feature is maturity. So if our bond has a long maturity, we know the interest rate risk is going to be very high. Let me explain that with the help of an example. If there is a bond with 1 year time to maturity, say the present value is 90, this is present value of the bond, or we can write simply value, and par value is $100. So the difference between these two is say $10 in this case. Suppose if we have 5-year bond, then the value is going to be much less. The value will be say $60. Okay, if the par value is $100, the value is going to be lower. So the impact of interest rate change on this bond is going to be much higher than the impact of interest rate on this bond. If interest rates are changing, it might change between 88 to 92 since the time to maturity is much less. But in this case, the value might fluctuate a lot more than this. So the longer is the maturity, the greater is the interest rate risk. Now let us look at the second factor, which is coupon rate. As we have already seen, if a bond is paying more coupon rate, it will be traded at a premium. And if it is giving a lower coupon rate, it will be given at a discount. So for the case where the coupon rate is lower, that is the bond is being traded at a discount, we are expecting more amount of money to be paid at the end as principal. So that signifies greater amount of interest rate risk. While if we compare it with higher coupon rate, that says the bond is being traded at premium, so less amount is expected at the end. So the effect of interest rate in this case is lower interest rate risk. Now let us look at third factor, which is embedded options. So we have already seen the relationship. The price of a callable bond is going to be less than the option free bond, and the difference is the value of this call option. We know since the borrower is going to have this option, for an investor the value will be lower. And if we talk about the price of puttable option, it is going to be price of option free bond plus price of embedded put option. So let us take the case where we have a puttable option. If the interest rate suddenly falls, the interest rates are falling. So what will happen? The borrower will not be able to call because there is no call option here. So there is no effect. If the interest rate is rising, then the price of the bond will fall. But since we have puttable option, we can sell the bond to the borrower at a predetermined price. So that is why the risk of the investor has come down. So if the interest rate is rising, the price of bond is falling, it cannot fall below the value at which the bondholder can sell the bond back to the borrower. So that is why we are protected due to this put option. So if we have put option, the interest rate risk is going to be lower. Now let us take the case of floating rate security. As we know, for the floating rate security, the coupon rate is tied to a reference rate. So it keeps varying, because of which the par value of the bond remains same as the value of the bond. But this relationship is true only at the dates of the coupon. As we know that coupons are only paid at certain predetermined dates, between them there is an interest rate risk even for the floating rate security. Because during this time it will respond to the changes in the interest rates. There are three factors on which the price of floating rate security will depend. First is the time between coupon reset dates. If the reset dates are very close to each other, then there will be no effect of interest rate. But if they are very far away, suppose they are annual, so the time is longer between two coupon dates, the interest rate risk is higher. The price of the bond will respond to these changes if this time is higher. The second factor is changes in the margin required by the investor. So when we are very close to reset date, the margin required will be less and the interest rate will be, risk will be less. And finally, the third is the presence of a cap, increases the interest rate risk. Let us see how. So if the interest rate goes up, right, the price will fall. But since it is a floating rate security, our coupon is also proportional to interest rate. So coupon will rise. So this is going to compensate the price fall. But if there is a cap, that is the maximum possible value of coupon rate, then our coupon rate will not rise beyond this cap. So that is why that interest rate risk will be there. So that is how the presence of cap will increase the interest rate risk. Now let us move to the next concept, which is of duration. Duration is the concept which try to capture the relationship between the bond's price and the interest rate. So basically it is trying to capture the interest rate risk. So the duration can be defined as the percentage change in the price of the bond for 100 basis point change or 1% change in yield. So if our market yield is changing by 1%, by what percentage our bond price should change? Bond price percentage change. This is what is our duration. So this is the formula. It says price when yield decreases, so price will be higher, minus price with yield increase. This price will be lower. Since yield is increasing, the price will come down, divided by 2 into initial price into decimal change in yield. Since we know that the response on increasing and decreasing the yield may not be the same, so in this formula we are trying to capture both decrease and increase in yield, so that the impact on the price due to both changes come into the picture while the calculation of duration, and that is why we are dividing by 2. So let us take an example. If the market yield goes up by 0.25% or 25 basis points, market price of the bond goes from 990 to 980. So since the yield is going up, the price is falling. When the market yield goes down by 0.25%, the bond price increases to 1010. So we need to calculate the duration. So let us see, when yield decreases, the bond price rises to 1010, and when the market yield goes up, the bond price comes down to 980. So this is the difference divided by 2. This was the price at the starting, and this is the percentage. 0.25% is 25 basis points. So here we have written it in decimal, so it is 0.0025, and the answer is 6.06. So this says if the interest rate rises by 1%, the price of the bond will fall by 6.06%. So duration is the basically relationship between them. And we can have dollar duration if instead of percentage change in the price, we talk about the percentage change in terms of dollar. So it is dollar price change for 100 basis point change in the market yield. So in this case, if we have to calculate the dollar duration, we can just take the price in the starting, which was 990, into percentage duration, which is 6.06%. If we multiply, we get the dollar value. So this value will be equivalent to the change in the bond price which we are expecting when there is 1% change in the market yield. Now let us move to the next topic, which is yield curve risk. If we notice in the case of duration, we have assumed that at all the points the percentage change in the bond price with respect to the percentage change in yield is going to be the same everywhere, which may not be the true. That duration relationship can be true only when there is a parallel shift in the yield curve. Yield curve is nothing but the relationship of market yield with respect to the maturity. So for example, this is 1 year bond, this is for 2 year bond, this is for 3 year bond, this is for a 5 year bond, and so on. This is the value of interest rate in the market. So this is our yield curve. So if all these bonds are responding in the same way to a change in interest rate, it is called as parallel shift. But if all these bonds are not responding in the same way, for example, if the interest rate for this particular bond is not changing as much as it is changing for 5 year bonds, if this change is more than this change, we say that the shift in the yield curve is non-parallel. So the assumption which we were taking in the case of duration gets violated here in the case of non-parallel shift. So we cannot take an assumption that for all the maturities the interest rate shift is going to be the same. So to address this issue, we use key rate duration, which is duration with respect to a particular point, which is used for unparalleled shift of yield curve. Now let us move to the next slide. Let us look at the disadvantages of call and prepayment risk. We have already seen that if the option has been embedded into the bond, a call option, it gives a right to the borrower to buy back the bonds at any point in time and return the funds to the investor. So for the investor, the disadvantages are the uncertain cash flow pattern. The investor does not know when the borrower may return the money. If there is a decrease in the interest rate, the investor will not find an opportunity to invest the cash flows which he is getting. Or in other words, if the calling provisions are exercised, if the bond is called, prepayment is made, then investor may not be able to invest at higher interest rates if the interest rates are decreasing. And finally, the appreciation in the price of the bond might be less than the option free bond. Because of this call option in the bond, the value of the bond will be less. So this is another disadvantage. Now let us look at the other risk, the reinvestment risk. As we have just seen, if the investor gets an unexpected cash flow when the interest rates are falling, he or she will not be able to invest at a higher rate. So that is called as reinvestment risk. For example, if the interest rates fall, the coupon which the investor was receiving periodically will be invested at a lower interest rate. So that is the reinvestment risk. So higher is the coupon rate, higher is the reinvestment risk. Also, if there is possibility that principal itself can be prepaid, before the structure, then the reinvestment risk will be even higher. So if there is a possibility of call, if it is a callable bond or prepayable bond or amortizing security, the principal may be paid before time. So that cash flow has to be reinvested by the investor. So reinvestment risk becomes higher. So if we notice that impact of interest rate is opposite on interest rate risk and reinvestment risk, that is why lower was the coupon rate, higher was the interest rate risk. So if we try to decrease our interest rate risk too much, our reinvestment risk will rise. So we need to make a balance between these two. Now let us look at the other types of risk. Credit risk is another important risk associated with the bond. So if the investor is not able to repay the principal, or if he is not able to pay the coupon as promised on time, it is called as credit risk. So it could be of three types. There could be three categories of credit risk. First is default, when the borrower is not able to meet the obligation. The second is credit spread, where the risk of not paying back rises. That is called credit spread risk. So value of bond will fall if the credit spread is increasing. And the third is downgrade risk. If the credit rating agencies are giving a lower rating, that will indicate there's more possibility of default risk, and because of that the value of bond will fall sharply. So all these three indicates credit risk. Now let us move to next type of risk, which is liquidity risk. Liquidity basically refers to the ability to transact. If we are able to buy or sell immediately, that indicates liquidity is good. But if bid ask spread is high, that means liquidity risk is higher, liquidity is poor. So it is an indicator of liquidity risk. Let us see how. We know that we will not be able to buy and sell at the same price in the market. Suppose the bid is 150.2 and ask is 150.3 for a bond. So if we want to buy, we have to buy at this price 150.3, and if we want to sell, we'll be able to sell at 150.2, because there is the buyer with maximum price 150.2 and there is a seller with the least price, which is 150.3. So we can buy from this seller who is giving us the best price, and we can sell to this buyer which is giving us the best price. So if the spread is small, we are not losing in the transaction, but if due to illiquidity of the security, if the bid ask spread is very high, say 145, 155, that means we are going to lose a lot in the transaction. So higher bid ask spread is indicator of higher liquidity risk. So for an investor who already has a bond, liquidity risk indicates that he will have to sell its security at a lower price. So even an investor who is not planning to sell the security before maturity, is planning to hold it till the maturity, even for him there is a significant liquidity risk, because that will reduce the price. If there is illiquidity, that will increase the premium and decrease the price of the bond, which means the lower return on the bond. So liquidity risk is affecting even to those kind of investors who are planning to hold the security till maturity. Now let us move to the next topic, which is exchange rate risk. When an investor is investing in a country other than his, the foreign exchange risk comes into the picture. So it is risk of receiving less cash flows because of the change in exchange rate. So this happens due to depreciation of domestic currency. For example, if somebody buys a bond for $90 and say if the investment is in rupees, and for simplicity say $90 is 1800 rupees. So he buys a bond at 1800 rupees. He pays $90, converts it into rupees and invests in the bond. Okay. Suppose after 1 year the value of this bond becomes 2000. So the person has gained 200 rupees. But when this person tries to convert this currency into dollar, the exchange rate is changed. Earlier it was 20 rupees per dollar, and suppose the currency depreciates to 50 rupees per dollar. So this 2000 rupees will become $40. This person has gained in terms of rupees in this bond, but has lost in terms of dollar because of the exchange rate problem. The depreciation of the domestic currency has led to loss in the investment. So this is called exchange rate risk. Now let us move to the next slide. The inflation risk. This is the risk of increase in price of goods and service. So we lose the purchasing power. If price of goods and service rises beyond a level, the purchasing power of the investor is suffering. For example, if the coupon rate is 7% and inflation is 4%, the purchasing power is increasing only by 3% because of the inflation. The value of money itself is coming down due to inflation. So while investing, we need to consider what is the inflation. And if it suddenly rises, the investor will tend to lose because their money will have less purchasing power. Now let us move to the next slide, which is about the volatility risk. So volatility is applicable when we are having an embedded option in our bond. So as we know, the value of an option, whether it is call or put, is directly proportional to the volatility of underlying. So higher is the volatility of the price of underlying, or we can say higher is the uncertainty in the value of underlying, the higher is the value of your option. It could be call option, it could be put option. If there is no change in the value, there is no volatility, then there is no value of call or put option. But if it is highly volatile, then value of option will be higher. So let us look at the callable bond first. By definition, the price of callable bond will be price of an option free bond minus price of the embedded call option. Since we know because of this call option, which is favoring the borrower and not the investor, the value of the bond comes down by this amount. Now let us look at the impact of volatility. We know when the volatility is higher, the price of call option will be higher. This value is higher, and in turn the value of callable bond will be lower. So higher is the volatility, lower is the value of callable bond. Now let us look at the impact on puttable bond. As we know, the price of option free bond plus the price of put option gives us the value of bond. The plus symbol indicates that since the put option is favoring the investor, so the value of the bond is higher due to this put option. Now as we know, if the volatility is higher, the value of put option will be higher and the value of bond will be higher. So the risk will be lower volatility. So in this case, risk is higher volatility, and in this case risk is lower volatility. So if the volatility is lower, the price of put option is lower, and if this number is lower, the value of puttable bond is lower. So if the volatility increases, the price of callable bond fall. If the volatility decreases, the price of puttable bond falls. They have opposite relationship. So the volatility is impacting both the bonds in opposite way. Now let us move to the next slide. It talks about event risk. There could be specific events which can affect our cash flow, coupon payments and principal payments. They unexpectedly change the ability of an issuer to make interest and principal payments. It could be natural disaster. It could be sudden restructuring at corporate level. There could be some regulatory issues, etc. So these events are extraordinary events which cannot be predicted and they affect the ability of the issuer. So this kind of risk is called event risk, which is tied up to a specific event. Next is the sovereign risk. Sovereign risk is nothing but the country risk which is specific to a particular sovereign country. So if an investor is buying a foreign government's bond, there will be a sovereign risk associated with it. Since the government of a foreign country is promising to pay the interest, coupon and the principal, there is a sovereign risk. There is a possibility that credit risk might increase because of poor credit rating of that particular country. So the credit rating might decline, or government can repudiate its own debt, or there could be some difficult economic conditions because of which the government is forced to default. So because of all these reasons, the sovereign risk may arise. Now that brings us to the end of this topic. We have covered all types of risk which are affecting the value of a bond. Now let us take a few questions.